Hi class, I realized that I made a video for chapter 9 and it was like 2 hours and something long, and it was so long that probably not every one of you is able to watch it through. And so I'm making this another video for chapter 9, and hopefully I can finish that within like an hour or at least 80 minutes. So if you haven't get a chance to watch that video, please watch this video first. Okay, if you have any questions about those any particular topics or materials, you can go back to use that long version of video to see if we can have a better understanding of that topic, particular materials, or otherwise you can send me an email and let's discuss that question. Okay, so now let's get on chapter 9. All right, so chapter 9 is about oops Chapter 9 is on long-term or long-lived tangible assets and intangible assets. Okay, so first of all, what is tangible? What is long-term, right? So long-term assets are those assets will be converting to cash or being used up or sacrificed and consumed over more than 1 years, and this is not it is not intended for resale. It's not like it's not like inventories that we pallet up for selling purpose. So it has to satisfy both of these. All right, so first of all, it has to be used more than 1 years, and then 1 year, and it's not used for resale. Okay, and so in terms of long-term assets, we have two different types of long-term assets. First is tangible assets, and the other one is intangible asset, physical intangible long-term assets. Okay, so what are tangible long-term assets or long-lived assets? First of all, it has to be, you can really put your hands on it, you can touch it, you can feel it. Okay, those are tangible, right? And examples are buildings, land, or machineries and furnitures, and all of these things are long-term assets. It can use more than 1 year, right? And all these assets are subject to depreciation. Okay, those are long-term tangible assets. All right, and the other one is long-term intangible assets. That means those things that can be used more than 1 years, but really you cannot touch it, you cannot feel it, hold it on hand. Okay, so those are things like software, copyrights, patents, or legal rights, or things like and so to speak, these kind of things. Okay, and these are subject to amortization, but not depreciation, right? And remember, depreciation and amortization are only just two different names for exactly the same process to discount its value because we're using it up, right? So or goodwills or trademarks. All right, and these are intangible assets, but some of the intangible assets can be amortized, but some of them are not able to be amortized. And because some of these intangible long-term assets, they have a useful life, but for some other intangible assets, they don't have something called useful life. It's unlimited life. Okay, so if it's unlimited life, then intangible long-term assets will not be amortized. All right, so now tangible assets, man, and think about this. Okay, no, there's an example. Okay, think about this. We buying a car. Okay, we buying a car, and when we buy the car, let's say we paid $10,000 for this car. Okay, and by the time we walk into the dealer and pick up a car and pay for the car, hopefully we paid with cash. There's no down payment or financing at all, and this what $10,000 we paid is acquisition cost to us. Okay, it's acquisition cost to us, and if we're a business and buying this vehicle for a business purpose, and this $10,000 will be the cost of the assets, and that is the value of this particular assets, this car, to us. Okay, it is not something like a fair market value that everybody can reach to it and pay for it. It is just we paid the $10,000, and on our balance sheet, let's say the equipment, okay, and that balance for this piece of equipment is just $10,000. Okay, so this is the acquisition cost, and along the business operations, we're gonna use this car, right? We're gonna use this car, and you understand this once at the start when we purchase this new car, and during the first several years, and the car is really drives so well that you can drive it across the country, right? You can drive from here to the western coast and to take a vacation in California, right? But then later on, when it's past, it's like 8 years or 10 years, and you have so many mileage on your car, and there's some problem with with tires, with transmissions, with your with the engines, and it's not be able to drive that far. So probably gonna drive in a very short distance, right? So then that is the use of the car, right? The use of this equipment, and so eventually we're gonna use up this piece of equipment. We're gonna use up this piece of equipment. Okay, so then for business purposes, we have to, for this intangible tangible assets, we have to depreciate, right? What is depreciation? Depreciation is to match the cost with the revenue it helps to earn, right? So this is going to be depreciate along its useful life, okay, during this useful life. And then at the end of the day, we're going to have something called a disposal value. What is disposal value? Let's say now it comes to the end of the end of 10th year, okay. This is 10 years later, okay. This is 10 years later, and then you decide to upgrade your car. You decide to upgrade your car, and you don't junk your car, okay. So even if you junk your car, you're gonna get something back, right? Let's say $100 or $200, whatever, right? And but let's say you're gonna trade in this car for a new to buy a new car, right? So let's say we trade it in for $1,000, and we can spend this $1,000, and on top of that we add several other grants to buy a new car, and this trading dollars is called a disposal value. Why is called disposal value? Because we get rid of it, and we get in return we get $1,000 back, so it is called a disposal value. Okay, and to record the disposal of this piece of equipment, right? So so acquisition. So when we purchase this piece of long-term fixed assets, what are those costs has to be included in the cost of this for this equipment. Okay, so first of all, definitely it's gonna be purchase price. Let's say we pay $10,000 for the car, and that's purchase price. And that purchase price has to be part of the acquisition cost for this piece of equipment. And besides this purchase cost, we also have to include some other costs as the cost for us, the company who is buying this piece of equipment, for us as the balance for this piece of equipment on the balance sheet. Okay, and acquisition costs include all normal and reasonable expenditures necessary to get the asset in place and ready for intended use. Okay, so now let's say we purchase this car. Let's say it's Tesla, okay, Tesla, and this Tesla, we buy it on their website. We buy it from their website, and it's cost $10,000. Hopefully, it's that cheap. Some other in the future, okay. So we the purchase price is $10,000, and it's just their purchase price, and they're gonna deliver this vehicle to us at in front of our door, in front of your door, and we have something called transportation cost, right? And for we to get this Tesla to drive and we have to, pay this $10,000 purchase price and this transportation cost. And this transportation cost, it is normal and also it is reasonable expenditures for us to get this Tesla, or another way of saying this is to get this assets in place and ready for use. Okay, ready for use. Okay, and this process is called, with including all these necessary cost into this acquisition cost for tangible assets. We call it capitalization. What is called capitalization is we record all these expenses as assets. Okay, what is assets? Assets are resources that we are going to use or going to be sacrificed for business purposes, right? And specifically it's for revenue generation generating purpose, right? So this is called capitalizing. All right, and all these expenses or all these out-of-pocket expense will be capitalized. That means we're gonna record whatever these costs, the purchase costs, the transportation, the insurance, that all these things necessary for us to get this piece of equipment in shape for its intended use. We're gonna record all these costs as we're gonna add all these together and record it as the equipment balance. Okay, let's say we pay $10,000 and for the car, and $1,000 for transportation, and in total is $11,000. And for this piece of equipment on our book, the balance sheet, we're going to record $11,000, and that is the cost for this equipment, and that is the worth of this equipment to us, and it's reflected on the balance sheet as the ending balance, as the balance for this equipment. All right, and so what are those costs we have to include when it's come to acquiring the long-term tangible assets? Okay, so for buildings, it's not only the purchase construction cost. If we purchase the already existing building, and then it's going to be the purchase cost. Otherwise, if we build a new from ground, then it's from scratch, then we have to pay this construction cost and some legal fees, appraisal fees, and architect fees if you design your own house. Okay, all these expenses are necessary, and also it's reasonable to charge all these costs before we can get this building for its intended use, right? And equipment, the purchase and construction cost, and also we're going to pay taxes, right? Everything we buy, we're going to pay taxes, and taxes will be included or so-called capitalized. All right, and transportation costs, and if you have insurance coverage, and if you're paying the insurance, and you're gonna insurance also is going to be included. Okay, and installation costs. All right, for example, this roller coaster, you buy this roller coaster if you're amusement park. Okay, and those things will be delivered by in pieces, right? It's not going to be operational, just spread around the pieces, right? We have to have somebody to install and put them together and test it out, and to see if it's really running as it's supposed to be, and there's no risks. I mean, stopping the cart, or throwing people off the cart, right? So this installation cost also is necessary and reasonable, so that'll be part of your equipment cost. And land, the purchase cost, legal fees, service fees, and title fees, all anything. Okay, now, this is just the general examples. So anything that you have to pay before you can really use these assets for your business purpose, those things has to be included in your in the cost for this piece of equipment or assets, tangible assets, long-term assets, or fixed assets. Okay, so these are the acquisition costs for these fixed assets. And acquisition, so this is called tangible assets, but if you're looking at some financial statements or balance sheets from some companies, probably going to see PP&E, that is called plant, property, and equipment. Okay, PP&E it's plant, property, and equipment, and also known as AKA, right? Also known as uh, fixed assets. Okay, fixed assets. Okay, and tangible long-term assets, fixed assets, PP&E, they all talk about the same thing. Okay, it's just a different names, nicknames. Okay, for this specific type of assets of any type of any companies. All right, it's not really it's the medical term. The PPE is not really the medical term that we use. We all see recently, right? And acquisition of tangible assets, basket price purchase, the total cost of a combined purchase of land and equipment is allocated in proportion to their relative market value. What it means, well, I wanted to think of that bundle sales in chapter 3. Okay, so in that chapter we talk about if we're selling products in the bundle that contains different type of products, how do we allocate revenues between those products, right? It's a similar idea here. If we're buying something and we're going to record those on our balance sheet, right? And how much, let's say we paid $10,000 for like this building and land in total, okay? And how much of this $10,000 really should record as the land cost, and how much of that should record as the building cost, right? So now we are using something is relative market value, okay, to allocate this $10,000, the lump sum price we paid to get both of these assets, okay? So for example, let's say if we have, okay, so here on January 1st, Jones purchased land and building for $400,000 cash. The appraisal value are buildings 325 and land 175. And how much of this $400,000 purchase price will be assigned to the building and the land accounts? Okay, land accounts. So if the appraised value here is if we are buying these two assets separately, how much we're gonna pay for each one of these. Okay, so if we're separately buying the building, we're going to pay 325, and land we're going to pay 175. In total is $500,000, right? But at the end of the day, we're buying these two together, we're only paying $400,000. So based off on their relative market value, we're gonna use the percentage to allocate this $400,000. How do we do it? So the land is 175 and building is 325, in total 500. And out of this 500, the land 175 is 35% of this $500,000, and you can see the calculation from here. Okay, and the other 65% will belong to buildings. Then we're going to use this percentage to allocate this purchase price $400,000 between the land and building. And 35% of $400,000 is 140, and 65% will be $260,000. Okay, so then when we record all these things on our books, the balance sheet, we're gonna record land $140,000 and building $260,000, and that's it. Okay, so this is how we allocate the acquisition cost when it comes to bundle purchase or basket purchase, so to speak. All right. So acquisition of tangible assets in example. So the fair purchased a new ride for $26 million, less than $1 million discount, and the seller fair paid $125,000 for transportation and $625 for installation of the ride. Prepare the journal entry for the acquisition, assuming seller fair assigned a note payable for the new roller coaster and paid cash for the transportation and installation cost. So now when it comes to acquisition, you see we are calculating the net purchase price and plus any other necessary costs. So in this case, the net purchase is not 26, it's really taking this $1 million out, net purchase is $25 million, right? And then along with this 125 for transportation and 625 for installation. So in total is 25 million plus $750,000, right? So there'll be 25.75. Okay, um, I think my math is right. But let's show this, okay? So now we are getting a piece of equipment, okay? Here is the calculation. All right, you see, okay, the invoice price minus the discount, and we have the net purchase price, and plus all these necessary costs is $25,750,000. So then, how do we record this journal entry, right? How do we record this journal entry? So remember, when we are getting a piece of resource, this is our assets, right? And assets increase on the debit side, so we're gonna debit this assets. Let's say it's equipment or whatever. Okay, so we're gonna debit this and this equipment, and how much we're going to record this equipment for is going to be this acquisition cost. Okay, so now on the balance sheet, this roller coaster will record it as $25,750,000. All right, then how do we pay off this of $25,750,000? Is going to be through cash and notes payable, right? Remember here from the previous slides, we're going to sign a note payable for the purchase price and cash for transportation and installation, right? So then we debit equipment for 25,750,000 and credit cash $750,000 because we paid cash for transportation and installation, and cash balance decrease, they will be crediting, right? And we sign a notes payable, so we're gonna pay later at a later date, right? At a later date for the purchase price, okay? And that's $25 million, and you add it up, it equals to 25,750, which is the debit balance for equipment. All right. So I know I'm talking a little bit fast. If you are having difficulty to understand or digest this process, just watch it slowly, or watch it one more time, or just it's better way to review your materials in the textbook. Okay, and after we purchase this, we have to constantly to maintain and do maintenance on these on these fixed assets. Otherwise, they will not be operated be not operated as smoothly. Okay, so and then in terms of maintenance cost, we have two different types of maintenance. One is called ordinary maintenance or repairs. One is called extraordinary repairs and replacement or others. Okay, so in terms of accounting, how do we record ordinary and extraordinary maintenance costs? Do we expense them out? Do we capitalize them? Okay, so for ordinary maintenance, we're gonna just expense it out. It's just the necessary cost of doing business. Okay, so this will help you to make revenues and expense it out whenever it incurred. Okay, if it's extraordinary cost, then we're gonna capitalize it, which means we're gonna put whatever the money you spend on fixing this into the fixed assets balance, okay, into the fixed assets accounts, and reflect it on the balance sheet. Okay, so what is ordinary, right? It says relatively small recurring expenditures that maintain normal operating conditions. And second, do not increase productivity. Three, do not extend life beyond original estimated. So let me give an example. Okay, my car, right? Now, my first car, it was a used car, and I paid $4,200 on that. And after I get this car, and I need to do oil change every 3 months or every 6 months, right? Every 3 months or every 6 months. And all these oil changes that I did on that car is just a small recurring expenditures to keep my car operational as it's supposed to be, right? So it doesn't really extend this useful life. It is going to be used for 10 years. Just doing my regular oil change will make sure that it will be running for 10 years, right? If otherwise, it will be shortening this lifetime. If it's shortened lifetime without doing that, it doesn't count. It doesn't count, okay? Because your intent original useful life is just longer than that. It's because we're not doing appropriate maintenance, which shorten the life of this equipment. Okay, so just not beyond, but if it's short, without doing that, we'll shorten the original useful life. Doesn't count. Okay, and so those maintenance costs, oil change will be expensed out. And for extraordinary repairs maintenance, it's relatively large, infrequent expenditures such as major overhauls or replacement of major components, and may extend useful life and may increase productivity or efficiencies. All these things will have a dramatic change of the equipment, will capitalize these costs. Okay, so that way we're increasing the balance of this assets account. Okay, so back to my car. Okay, back to my car, that the one that I paid $4,200. So a year later, really a year later, the engine was dead. Okay, the engine was dead, and I paid $3,000 to fix the engine. Okay, to fix the engine. Okay, and do I really, or does anybody really put $3,000 on their engines into their cars every year or every month or every other year? No, really, right? So it is really a large in terms of the cost, original, acquisition cost of mine. Okay, it's really a large amount of cost to me, and it's infrequent. And also by putting this $3,000 in to fix that, and to replace that engine, I can potentially extend the useful life. Right? It used to, running by another 2-3 years, and now because I'm putting a brand new engine into it, you're probably gonna run another 4 or 5 years. Okay, that makes sense. And also it will increase the productivity and efficiency. Of course, I don't have to do the premium oil change, right? I just can do the regular oil change, and in terms of that, right? So to speak. All right, so all these maintenance costs, you have to be able to distinguish between ordinary and extraordinary maintenance, right? If it's ordinary maintenance, expense it out and report it on the income statement in the period where it incurred, and extraordinary, we're gonna record in the assets account, report on the balance sheet, right? All right. So then it's come to the depreciation. After we figure out how to record the acquisition cost and how much acquisition cost for that piece of equipment we need to record on the balance sheet. Now it's come to depreciation, right? And depreciation. Remember, when we record depreciation journal entries, we use a term DEAD, debt, which means during the time that we are using this equipment, and we are really draining out the resource or the capabilities out of this equipment, right? And until some later date, it will not be useful, or will not be capable to use for future, right? So then it'll be that. And so, what is depreciation expenses really is, and how and why we are doing depreciations on fixed assets? Okay, so the problem, the idea or the theory behind depreciation process is the matching principles. Okay, is the matching principle. What matching principle is that we're going to, or we have to match the costs to the revenues that it helped to earn in the same period, right? So let's say we're doing a business, and we need to hire employee and pay that employee $10,000 a month for selling our the products, and that $10,000 salaries will be expense, right? Will be expense, and that $10,000 has to be matched with whatever the revenue that earned in that period, because without this necessary costs, we are not able to even earn anything during this period, right? So those are the critical costs for earning the revenue in that period. And a similar idea that really companies buying long-term assets, those fixed assets, buildings, machineries, and lands, really they are used for business purpose, right? So what is business purpose? They are used for earning revenues. They are used for earning revenues. Without any of these assets, we are not able to earn revenues, right? So we don't have buildings. We don't have buildings. Then where should we work, right? We don't have a workplace, and we don't have machineries. We don't have machineries where we're gonna make our products, right? We don't have a store to sell it, and how are we able to sell it? We don't have people to maintain our website. How are we able to do online sales, right? So all these are assets necessary for doing business, and those revenue earnings is the business purpose, right? So we have all these things, and especially for fixed assets, because they are used more than 1 year, right? They are sitting on our book, and the physical thing will be used more than 1 year, right? So they will help us to make revenues for more than 1 year. And because we have these matching principles by GAAP, we have to match all these costs with the revenue earned. So then when we use fixed assets, we have to find a arbitrary or a theoretical or mathematical way to figure out how much of these or what portion of this piece of fixed assets is being used up, or we used during any particular period to help us to promote revenues, okay, to promote revenue. All right, for example, we let's say a piece of assets is $10,000, okay, and we estimate that this year we use the $1,000 the resource out of these fixed assets, and then we have to expense this $1,000 out of this $10,000 in this period of time, this accounting period, to match its revenues, okay, to match this revenues. And this process is called depreciation, okay, this process is called depreciation. All right, so first of all, we're gonna when it's acquisited, and we're gonna record it on the balance sheet, and then when it's depreciated, then we're gonna expense it out on the income statement, right? So depreciation expense, the depreciation for current year income statement, accumulated depreciation, total depreciation to date for any fixed assets on the balance sheet. Remember, the accumulated depreciation, it tracks how much of this assets has been depreciated to date. Okay, it is a cumulated number, help us to see out of this so much assets, how much of that, let's say $10,000, out of this $10,000 fixed assets, how much up to now, from the first day we receive this equipment up to now, how much of this $10,000 has been depreciated. But depreciation expense only report how much we used up in any particular period of time, okay, and usually it's 1 year or 1 month, okay. All right, so depreciation expense example, the effects of $125 of depreciation on the accounting equation and the journal entries will be recorded as follows, okay. Remember, you can see this, right? Depreciation, debit depreciation expense, and credit accumulated depreciation, and it's $125, okay. That goes to income statement, and this one goes to the balance sheet, okay. All right, here's how we report depreciation expense and accumulated depreciation on the two different financial statements. On the income statement, expense will be recorded under revenues, okay, and in the operating expense sections, okay, depreciation expense, that will be expensed out, and subtracting this number from your revenues, okay, and then along with other expenses, we're going to get our income from operations, right? And includes 125 for 2015. This is 2015 financial statements, okay. We're going to include that $125 in the accumulated depreciation. So this $1,400 already include this $125 of current year depreciation. So then look at this date, okay, it's the end of 2015, right? So up to this particular date, from the first day that we get any of these property and equipment, up to now, we have depreciated $1,400 out of this $2,910, okay. Out of this $2,910, we already depreciated $1,400 up to date. Okay, so this is the original cost, and this is the cumulative depreciation, and then the net, property and equipment net cumulative depreciation is $10. Okay, $1,510. It means out of this $2,910, we still have $1,510 to use in the future, right? So factors in computing depreciations. When we calculating depreciation expense, and when it comes, I think it's in the prior chapters, some students ask, how do we know how much we depreciate every year, right? And when it, in the previous slide chapters, I told you that just they'll be given to you because it's not the time that we're learning this, right? Now it is time that we're learning how to calculate depreciation expense. First of all, it is the three factors we need to look at when we calculate depreciation expense. First is acquisition cost, how much in total we paid for that assets, including the price and any necessary costs to get that piece of assets for its intended use. And then it's estimated useful life. How many years, how long you think that we're going to use this piece of assets, right? And and then comes to the end of useful life, and we're going to upgrade this assets, or we're going to buy another assets to replace it, right? And if that happens, and we're going to trade in or get rid of this, right? If we're getting rid of this equipment at the end of useful life, and how much we can sell it for, or how much we can trade in it for, that is called a residual value. What is residual value? Is at the end of useful life, how much of the original acquisition cost has not been used up yet, right? So for example, $10,000 of that equipment, and now its cumulative depreciation is $9,000. So now we have a net book value of $1,000, right? Net book value of $1,000, and now we are trying to upgrade these assets and get rid of this one, right? And this old equipment assets has a net book value of $1,000, which is our residual value, because up to now we only used up $9,000 out of $10,000 resource, okay, in terms of resource for the equipment or assets, all right? So that is a residual value. Okay, applying various depreciation methods as economic benefits are used up over time. Okay, economic benefits are used up as just, we use that machine, and we theoretically we think we are using part of the machine up because the productivity will eventually decrease along the time, right? So there are three different methods. First one is straight line, the second one is units of production, third one is declining balance. Okay, these three different methods going to give us completely different depreciation expense. Okay, so first let's use this example. Okay, the purchase price for this go-kart ride is $62,500. The ride has an estimated useful life of 3 years or 100,000 miles. Okay, useful life doesn't necessarily means the number of years. It could also be some other standards. Okay, it depends. So it also for our problem solving purpose, you pick up the information whatever is given. Okay, and you have to use your judgments. Okay, to see, well, less likely you're going to use your judgment to see, because it's going to give you into straightforward. Okay, and an estimated residual life of $2,500. That means by the time that we're going to upgrade or get rid of this go-kart ride, and I think that go-kart ride will be worth $2,500. So that means we're going to get $2,500 back at the end of the day, right? So those are the three things. And the straight line methods is really something that is used very common. So the formula here is the cost, which is the acquisition cost, right? Minus the residual value, which is give us the depreciable cost, because that is the net number. Cost minus residual value is going to give us the net number we are using to calculate depreciations, right? Because residual value is the amount of money we're going to get back. It's not really our um, uh, outflow, okay? Outflow, okay? And then times 1 over useful life, 1 over useful life, and this called depreciation rate, and then depreciation cost times the rate, how much you should depreciate per some units, and give us the depreciation expense, okay? Give us the depreciation expense. And I have a different explanations for depreciation rate, but just hold on this, okay? Let's look at this example. All right, the acquisition cost is $62,500 minus the $2,500, the residual value. In total, the depreciable value is $60,000, and times 1 over 3, and so each year we're going to depreciate $20,000, right? Each year we're going to depreciate $20,000, okay? So if we're recording depreciation expense, we're going to debit depreciation expense for $20,000, and then credit accumulated depreciation for $20,000. This will goes on current year income statements. They will be included in the cumulative depreciation reported on the balance sheet, right? Okay, all right. So let's finish the 3 years depreciation calculation. Okay, here is the chart. So the first year, the amount will be $20,000, and original, when it's at acquisition, we don't have anything to depreciate, right? We haven't used any part of that yet. So the cost is $62,500. The book value will still be $62,500. And after a year of use, we used up $20,000. So out of $62,500, we depreciate $20,000. Now we only have $42,500 left for future use, right? And after second year of use, and we used up another $20,000. So here we still the acquisition cost, original cost is $62,500, but accumulated depreciation means that up to the end of second year, we used up $40,000 in total. That includes the first year depreciation and the second year depreciation. And now at the end of the second year, we only have $22,500 left for future use. That makes sense? And then comes to this the third year. After the third year, and we're gonna use depreciate another $20,000. So out of $62,500, $500, we totally depreciate $60,000, right? The 3 years we depreciate $60,000, and which leaves us this $2,500, and that is the residual value, which means out of this $62,500, we still have $2,500 unused. If we're selling this at the end of third year, we're gonna sell it for $2,500. Okay, so that is residual value. All right. So what I mean, I have different definition for depreciation rate, because really when we have this depreciable cost, let's say it's $600,000, okay, when we have this depreciation cost and we're looking at how much we need to depreciate per year, right? So basically, and this is a coincidence that divided by 3 is going to give you the exact same $20,000, but really is how much we are depreciate per unit of the measure, right? How much we're going to depreciate the per unit of the measure, and the measure here is year, okay? Year is going to be $20,000. It's really not 1 over 3 is the depreciation rate. It doesn't really read anything, okay? It doesn't really read anything, okay? So give you another example, okay? Now let's look at units of production methods, okay? Unit of production methods is formula is similar, okay? Here we still have this depreciable cost, which is cost minus residual value, and multiplied by actual production this period over estimated total production. Okay, and it could be production, it could be mileage. It depends on what other mileage measure you use to depreciate your fixed assets. Okay, so besides we can use a number of years as definition for useful life. Now in this case, we have another thing, it's called mileage, right? Mileage, and our useful life is estimated for 100,000 miles. Why? 100,000 miles. 100,000 miles. So in this case, still going to uh, um, depreciate. Still going to depreciate $600,000. But in terms of using years, now we're using the mileage, right? So if the rate is used at $30,000 miles in the first year, then the first year we use the 30,000 miles, and out of this 100,000 miles, we're going to depreciate $18,000 in the first year, right? So now I'm saying this, okay? So the depreciation rate in this case really is the depreciable cost over the depreciable cost over the estimated total production per this equation, right? Because this for each unit production, for each unit of the measure, how much we're going to depreciate. That should be a rate, right? Because rate, the measure should be fixed per unit of measure, and depends on how much measure how many units the measure you use, then we can calculate. Anyway, if you can understand my explanation of that, it's better from my perspective. If it's not, just stick with this formula, okay? So that's 600,000. Okay, if you're divided by 100,000 miles, that means we're going to depreciate 60 cents per mile that are driven, right? So now in the first year we write 30,000 miles, and that should be $18,000 expense, depreciation expense. All right. So now let's finish the other years. Okay, so first year we depreciate $18,000, then accumulated depreciation will be $18,000, and leaves us $44,500 on the book, right? And after the second year, which we write 50,000 miles out of 100,000 miles. So using this formula, we're gonna depreciate $30,000 as our depreciation expense. And then in total, these 2 years, we depreciate $48,000, right? And out of this 62,500, we still have $14,500 left for future use, right? And now comes to the end of the third year, and in the third year, we write another 20,000 miles, okay, and use this formula. We depreciate $12,000. So in total, we depreciate $60,000 in these 3 years, and which leaves us $2,500 the residual value. Okay. All right, the declining balance method. So the theory behind the declining balance method is that, so when we get a new piece of assets, new piece of equipment, and usually the early several years they are more productive than the later several years that towards this end of the useful life, right? Because the efficiency and the maintenance and the parts or components of the equipment is not, sometimes it will be malfunctioned, or it's just not that becoming fragile, right? So we'll hinge the productivity. So now in this, using this method, okay, the calculation formula is a little bit different. We, instead of using cost minus the residual value, here is the cost minus accumulated depreciation, okay, accumulated depreciation, and times 2 over useful life. Then that is depreciation expense. Okay. So again, so what is the amount of depreciation for each year of the first 2 years. Okay, so based on that, the first year when we acquire or when we purchase this right, it's $62,500, but we don't have any accumulated depreciation because we haven't used that for any, right? So that's will be zero, the accumulated depreciation, and times 2/3. Remember, 3 is our useful life. Okay, it is our useful life. So then in the first year, we're going to depreciate $41,667. Okay. And then we're going to debit depreciation expense for that amount and credit accumulated depreciation for that amount. Okay. And now it's come to the second year. Now it's come to the second year. Now still the cost is the same, doesn't change, $62,500, and then minus the accumulated depreciation. Now the accumulated depreciation becomes $41,667, right? Because after a year we already depreciate that much. Okay, so then cost minus accumulated depreciation times 2/3. 2 always going to be 2. Okay, this is always going to be number 2, the number of 2. Okay, and then the second year we're going to depreciate $13,889. Okay, $89. All right. So here we really using declining balance method, we are ignoring residual value. There's nothing, in the calculation we're ignoring the residual value, but at the end of the day, when it's come to the very last year of operations, of using that equipment, we're still gonna factor in this residual value. How? Now let's look at the third year calculation. Okay, the third year depreciation calculation. So if we are using this exactly the same following this formula, we're gonna have a $55,556,000 accumulated depreciation. Okay, right here, depreciation, which is the sum of 41,667 plus $13,889. That equals 55,556. Okay, if we keep using these methods, then we have to depreciate $4,629 for the third year of use. Okay, however, if we are doing the depreciation calculation following this methods, see here, we're going to depreciate $4,629, and we will no longer subtract this number. We will no longer subtract. We're gonna the accumulated another way. Excuse me. Then after at the end of the third year, the accumulated depreciation will be $60,185. $60,185. How come? It just adds these three up is going to be our accumulated depreciation. If that is true, then our residual value will become $2,315, which is the difference between these two numbers. All right. However, we have an estimated residual value of $2,500. It's different from that net value, right? So now at very last year, okay, for the very last year of use of these assets, what we do is we first hold this residual value constant. Okay, we'll fix this value. Okay, we'll put that in first. Okay, so we will hold our residual value as $2,500. The initial estimated residual value, originally estimated $2,500, and then we are going to use this original cost, acquisition cost, minus the residual value, and to see up to the end of useful life how much in total we should depreciate. Okay, how much we should depreciate. In this case, it's $60,000, and then compare to the last year accumulated depreciation. Okay, compare to the last year of accumulated depreciation, and whatever the difference is, remember accumulated depreciation, it increased from year to year by that specific year's depreciation expense, right? So whatever the difference is, it's going to be the depreciation expense for the last year. And in this case, it's year 3 for the last year, right? So now it is $4,444. Okay, $4,444, which is $60,000 right here. The second column from on the right hand side. Okay, it is $60,000 minus $55,556. Okay, so that is $4,444. Okay, that will be the depreciation expense for the third year, not this one. Okay, not this one. All right, so summary of depreciation methods. Okay, if we're comparing these three methods, we will see in total they're always gonna depreciate the same amount at the end of the useful life, right? However, each year throughout this useful life, they're gonna depreciate different amounts in different years. Okay, so if we're using double declining methods, we're gonna depreciate more in the first year, and then a little bit less in the second year, and a little bit less after that, and less and less and less, right? And if we're using straight line methods, we're gonna depreciate exactly the same amount every year throughout its useful life. Okay, and if we're using units of production methods, it depends on the usage, right? It depends on the usage. Okay, it could be changed, it could be changing, right? So that is the affection. Okay, and also they will affect the tax. Okay, it will affect our income, net income. Okay, these different methods will affect our net income, and also affect our tax expense, right? Tax expense, because if you have a higher expense, you're gonna have a lower net income. Make sense? Okay, so this is, so if we have a partial year depreciation, how do we calculate that? It means that not always companies buying their piece of equipment for a whole year, right? You're probably gonna purchase some assets, during the middle of the year, let's say January, June, or even October or December. Okay, so when it's come to that, and we still need to prepare annual financial statements, and then we still need to calculate depreciation expense, right? And the assets not has been used up for a year, then how do we, the whole year, and how do we calculate that depreciation? Okay, so when a plant asset is acquired during the year, depreciation is calculated for the fraction of the year the assets is owned. Okay, so for example, if you're buying this assets at December 1st, okay, December 1st, and now your fiscal year end is December 31st, really you only used these assets for a month, right? You only use these assets for a month. So whatever the annual depreciation is, okay, using your calculation, you can calculate your annual depreciation expense. Okay, whatever your annual depreciation expense, just times 1/12, that'll give you a monthly depreciation expense. Okay, and times 2/12, okay, 2 months depreciation expense. Okay, 3/12, 3 months of depreciation expense. 4/12, 4 months of depreciation expense. You get the idea, right? All right, now explain the effect of assets impairments on the financial statements. What is assets impairments? Basically, let's think of the lower cost or fair market value or net realized value, right? If those assets, if those fair market value down below the cost on the balance sheet, we have to write it down or adjust it to its fair market value, right? So it's a similar idea here. Okay, it's a similar idea here. Okay, so impairment is when the estimated further future cash flow from a long-lived assets falls below its book value. Okay, from casualty, obsolescence, lack of demand for asset services, right? So let's say if our assets book value now is $10,000, and because our customer preferences has changed, they will no longer have demand from our companies, okay, and for that we're using this specific assets, and the revenue or the cash flows that we're going to bring in the future is cash inflow that we're going to bring in the future is $5,000. $5,000. Okay, so our future cash flow is not enough to cover the current book value. Okay, the net book value. So we need to adjust our net book value, our book value of this equipment down to $5,000. So basically, this is the process. Okay, this is the process. Why we have to do this impairment loss analysis? Because our idea here is that all these resources will be used up, become expenses, and to help to generate revenues. If the revenues is not enough to cover expenses, then we have to record a loss immediately. Okay, record a loss immediately. Okay, do not inflate our revenue, our income, net income for this current year. Okay, so what it means is that whenever we see that our future cash flow will not be able to cover the existing book value, whatever that period is, we have to do the impairment loss analysis immediately, not hold it off until a later date. Okay, so there are two steps. First is eliminate assets accumulated depreciation against the assets account, and second, write down the assets to its fair market value. All right, let's see how we do it. So the fair recorded an impairment loss of $8,600,000 on equipment. Okay, so first, the original cost is 10.6 million when it's opened in 2010. When the rider was closed in 2015, its accumulated depreciation was 2 million. So the first step was to net the 2 million against the equipment account as follows. Okay, so we will debit depreciation expense and accumulated depreciation for 2 million and credit equipment for 2 million. Okay, so why is that? Because we have an equipment account debit, okay, and original cost is 10.6 million, right? And we have a cumulated depreciation account on a credit side carries $2 million, and we have a calculation 10.6 minus 10.6 minus 2 million give us the net book value, right? Remember on the balance sheet, the original balance for the equipment will never change, because it indicates how much it costs us to acquire this piece of assets in the first place, and then we use accumulated depreciation to compare with this original cost to see how much has been used up, right? So really, in terms of book value of this for this equipment, we haven't changed anything yet. But now it comes to the time when it's closed, when it's closed, and which that means we're not going to be using this right for any longer time, and we're going to report this loss. Then first of all, we need to see how much this right is worth to us. Okay, how much is this right worth to us? If we're still looking at this equipment account, it's still going to be $10.6 million. Okay, it's still going to be this $10.6 million. Okay, and it's not something else. So if we're using this number to do the impairment analysis, the results will be not accurate. So first of all, we have to deduct all these accumulated depreciation from equipment to get accumulated depreciation balance of 0, because 2 million credit out from accumulated depreciation will be 0 balance, and then subtract it from the equipment book value, and now the realizable value. Okay, now the book value on our balance sheet of this specific equipment is 8.6. Okay, 8.6. Now this 8.6 million, it is the true cost or true value to us. Now we can use this to compare the fair market value. Okay, so the second step, after the first step, the assets account shows the book value of 8.6 million. Okay, the second step was to write down this balance to the asset's fair value, which in this case is presumed to be 0. If this fair market value is 0, okay, remember equipment, it has a balance of 8.6 on the debit side. If we're thinking that this equipment only was $0 at the end of the day, we have to write off 8.6 million entirely, right? So then we need to credit 8.6 million for equipment, right? So then the second step journal entry will be debit impairment loss for 8.6 million and credit equipment for $8.6 million. Okay, so if somebody asks me if we have more values, seeing more values gonna coming in, or seeing more cash flows gonna come in, then we estimated originally. Are we gonna write up equipment balance? No, we don't care about that. Okay, only write down only when the future value is not going to cover our residual equipment balance or book value. Okay, book value. Okay, not residual value, book value. Now we need to do this impairment analysis to record impairment loss. There is no something called impairment gain. Okay, only loss. All right, analyze the disposal of long-lived as tangible assets. Okay, now it is the time to now it's come to the end of useful life, and then we need to get rid of this, right? So it's called a disposal, either trade it in or whatever. But trade it in, junk it, or sell it. Okay, it's whatever the way you call it, but this is gonna be called disposal on the balance sheet. Okay, how do we dispose this or get rid of this from our balance sheet? Okay, so first we're gonna update depreciation to date of disposal, excuse me, and second we're gonna record the disposal. All right, now here is how it works. Okay, so we're gonna debit cash first. We're gonna debit cash, and then second we're gonna credit equipment. We're gonna credit equipment, and then third we're gonna debit accumulated depreciation. Okay, then we're gonna for credit gain on disposal if cash received is greater than assets book value. Okay, it's greater than the assets book value. However, if it's so still first debit cash, second credit equipment, and third debit accumulated depreciation, and last one is debit loss on disposal, right? So we debit loss if cash received is less than assets book value. Now let me give you an idea why this journal entry is so complicated. Okay, why this journal entry is so complicated. It's probably going to take several minutes. Okay, bear with me, and this is very important. Okay, let me find a okay, so for example here, all right, now let's see, we have a piece of assets, equipment, let's say, and this this original cost is $10,000. Okay, $10,000, and this accumulated depreciation balance is $9,000. Okay, $9,000. Oops, $9,000. And then do the math. Our net book value is $1,000, right? Our net book value is $1,000. Now somebody is offering us a price to buy this assets at let's say $1,500. Okay, $1,500 price. Somebody offer us a price of $1,500. Okay, now our net book value is $1,000, and we can sell it for $1,500, which means we'll sell it for $500 more. Does that make sense? we're gonna get about $1,500 for something that we own that is only worth $1,000. Then we sell $500 more, which we're gonna have a gain of $500 mathematically, theoretically. Okay, is that right? So we're gonna have a gain because we earned more than its cost, right? So then how do we do this journal entry? Okay, so first of all, you receive this $1,500 cash. You have to debit cash because your cash balance increased by $1,500. Does that make sense? Your cash balance, no matter what, your cash balance increased by $1,500, right? And second of all, because we are selling this piece of assets, that means after this we no longer have these assets and its associated accounts on our books. On our books, we no longer have this piece of equipment, right? So then we need to credit this equipment out of our book, which is $10,000, right? Which is $10,000. However, not only we have this $10,000 for this equipment, the accounts, but also we have something that's really related to this account. If we don't have this equipment, we will no longer have we don't have to have this accumulated depreciation, right? This cumulative depreciation only help us to see how much, or only help us to track how much up to date out of this $10,000 has been used up by us. And now it's $9,000 because this is gone. Also, this account has to be gone out of our book, right? So to get rid of this, then this is a debt credit balance of $9,000. Then we need to debit, okay, debit. We need to debit accumulated depreciation of $9,000. Okay, $9,000. Okay, so up to this point, no matter what, as long as you are disposing your fixed assets, you're always going to debit cash and debit accumulated depreciation for whatever that balance is, and credit equipment for this acquisition cost or original cost. Okay, and now we are filling this part because we have a gain of $500, right? Not, and you see this, the difference here is $1,000, right? So that is the cost for us. And then we're selling this for $1,500. Then really we have a gain, and that gain will be on the credit side. Gain from disposal or gain on disposal, $500. And if you do the trick, that add up is 10,500. And here, this before we make this gain entry, they will only have $10,000 on the credit side, so we have to fill in another $500 on this side for make this balance. Okay, and then it's a gain. Okay, again, if we are selling this not for $1,500, okay, not for $1,500. Now we are selling it for only $500. What happens? Okay, not 5,500. Okay, if we're only selling it for $500, what happens? Still, we receive cash, right? Cash amount is changed, but the journal entry still is going to be a cash account, right? So debit cash for $500. Okay, and then still we're gonna debit accumulated depreciation from that $9,000 and credit equipment for $10,000, right? We still have to have these accounts entries, okay? And then now, because our net book value is $1,000, now we're only selling it for $500. We really sell it less than what it's cost us, right? So we really, from this transaction, we're losing $500, right? We're losing $500, okay? So that'll be a loss on disposal. And loss on disposal is recorded on the debit side. Loss on disposal, which is $500. Also do the trick. Debit balance, a credit balance has to be equal. And then before we make this entry, okay, we have $10,000 on the credit side. We have $9,500 $100 on the credit on the debit side. Excuse me, we have $9,500 on the debit side. We have $10,000 on the credit side, which means we are $500 short on the debit side. Okay, that'll be a loss on the debit side. All right. So this is why we're gonna do this. Okay, now let's do this example. Okay, and so the amount of depreciation per year, the roller coaster is $50,000 cash at the end of the 6th year. The equipment's original cost $100,000 was depreciated using straight line method with zero residual value and has a useful life of 10 years. Okay, what is the amount of depreciation per year? Okay, original cost is $100,000 and the useful life is 10 years, and with residual value of 0 divided by 10, which will be $10,000, right? So that'll be a C. Okay, and now it's the book value at the date of sales. Okay, so at the end of 6 years, right? The roller coaster for a salary for $50,000 at the end of 6 years. So each year we depreciate $10,000, and now we use it for 6 years. How much in total we depreciate? So the cumulative depreciation is $60,000, and the original acquisition cost is 100,000. So the book value up to date, or net book value now, is 100,000 minus $60,000 is $40,000. Make sense? So that'll be A. Okay. And now it's come to the disposal, right? Disposal. And the sales result, a gain or a loss. Okay, so now the net book value is $40,000. Okay, and so let's this. The net book value is $40,000, and then the price is $50,000. So we sell it $10,000 more. So then this will be a gain of $10,000. Okay. So here is the complete journal entry for this. All right. All right. Analyze the acquisition, use, and disposal of long-lived intangible assets. So now we're switching to the intangible assets. Okay. Intangible assets are not again, it's long-term, so it's not current assets, and it's not intended for resale. And sometimes useful life is not really easy to decide, to determine. Okay. And intangible means that you cannot touch on that, right? And so intangible assets we record at current cash equivalent cost. It's also the acquisition cost, right? Including all the necessary reasonable costs to get this for intended use. And amortize intangible assets with limited life over the shorter of their economic value of lives or legal lives, depends on which one is shorter. Okay, and only use straight line methods, okay. So now let's talk about these things individually. Trademarks and copyrights, you know what trademarks is and what trademarks are and copyrights are, right? So legal life is, creator plus 70 years and amortized cost over the period of benefits. Okay, whatever the number of years you use that legal rights or trademarks, the trademarks or copyrights, and you're gonna amortize over the years that you use them, you benefit. Okay, and use straight line methods. Okay, and patents and licensing rights. Okay, all these are intangible and amortized costs over the shorter of useful life or 20 years. Okay, if you have more than 20 years of useful life, only 20 years for amortization. Okay, again, use straight line methods only. Okay, use straight line methods only. And what is acquisition cost? All the costs, including purchase costs and other necessary costs. Okay. And technology assets and franchises. Okay, again, usually over a relative short period, 3 to 7 years, depends on the number of years you're going to franchise with a specific company. For example, McDonald's or Pizza Hut. Okay, all these are franchise. Okay, and you're franchisees, and then you're gonna use their repetitions to doing business, then you have to amortize your franchise fees, and it's whatever the number of years you use, then you're going to amortize them over the years using straight line methods. Okay. And goodwill is when it's come to buying a company. Okay, when it's buying a company, you have to pay for a sort of lump sum price, right? Before you do that, you're gonna sign up an appraisal team, right, to appraise how much that company is worth. Does that make sense? So when it's come to when you finish the appraisal process, you figure out that the company in total only worth like $50, okay? But now you're still paying, or they ask you for $90. Apparently, you are paying $40 more than what it's cost, right? What it's worth, right? So then you still pay that $90. What is this $40? This $40 is called goodwill, and this our assets. Why we're paying something that really not on our control, or we don't even see that, and that's some intangible resource. Okay, what is intangible resource for us? For example, the original the company's reputation, the company's market information, their customers network database, or their customers loyalty or confidence in the company, so on and so forth. All these things are contributing to considered goodwill. That is just the premium above this fair market value. Okay, so it is not amortized because really there's no way we can measure goodwill besides this economic measure, right? The amortization of limited life of tangible assets. Here's an example. Okay, each year the company would record $40,000 because it cost $800,000 in total, and it intended for 20 years of use. 800,000 divided by 20, it is $40,000. Straight line methods, right? And for intangible assets, there is no things called residual value. All right, residual value, no. Okay, residual value always going to be considered as zero. Okay. All right. So this is pretty much this is all about chapter 9, and this turnover ratio. You can look at it yourself. Okay, we run out of time, and also in that long version of videos, I have some detailed explanations on this. But for this purpose, no, we don't talk about that in this video, right? If you have any questions about this turnover ratio, or you come up with some difficulties when it's come to problem solving, let me know. All right.